Hello viewers, welcome to my channel. I'm Hasham Ali Khan. In this video, I'm going to explain you the topic of elasticity of supply. What are the different types of elasticity of supply and what is market equilibrium? So before this video, I have already started the unit number 3, that is supply analysis. In the last video, I have explained you about the meaning of the term supply, law of supply, determinants of supply, and then I have explained about the supply schedule, supply curve, then assumptions to the law of supply and exceptions to the law of supply. These are the topics already I have covered in the last video. So if you have not watched that, I suggest you go to the playlist of my channel. Select the subject business economics. Select the video of supply analysis. Be clear regarding the concept of law of supply. Then you come to this video. Definitely you can get a lot of command, lot of confidence on the topic of this business economics. So before starting the explanation of elasticity of supply, take the screenshot of the points which I have written on the board. Then I'll explain clearly about the elasticity of supply. Now, see here, the topic is elasticity of supply. Elasticity of supply shows the degree of change in sales of a product regarding the change in the price. That means whenever there is a change in the price, corresponding change in the supply. That means supply depends on price. So here the degree to which the supply of the product increases or decreases due to the change in the product is termed as elasticity of supply. That means whenever there is a change in the price of product, there will be a change in the supply. So the decrease or increase in supply due to a given change in the price is termed as elasticity of supply. So simple ones, elasticity of supply is considered as the responsiveness of the sellers to a change in the price of the product. That means whenever there is a change in the price of the product, how the sellers are giving the response, how the sellers are changing the supply. So responsiveness in the supply due to a given change in the price. That is called elasticity of supply. The following formula can be used for measuring the elasticity of supply. So one formula is there to calculate the elasticity of supply, ES. ES stands for elasticity of supply is equal to percentage change in the quantity supplied divided by percentage change in the price. So simple words, percentage change in supply divided by percentage change in price. That will give you elasticity of supply. The time element basically has significant impact on the elasticity of supply. Mainly time factor is very important in changing the elasticity of supply. Normally what will happen, there is more elasticity of supply in the long period. During the long period of time, there is more elasticity of supply. During the short period of time, elasticity will be zero. That means no elasticity. That means the sellers overnight cannot change the supply. It will take some time to change the supply. So immediately, if there is a sudden change in the price, suddenly the supply cannot be changed. It wants some time. So what will happen during the short period of time, it will be difficult to change the supply. That's why it is inelastic. Whereas in the long period of time, the producers, the suppliers will have ample time to change all the factors of production and change the supply. So we simply can say elasticity of supply is more during long period of time and elasticity of supply is very, very less in case of short period of time. Now, types of elasticity of supply. Broadly, we divide the elasticity of supply into 5 categories. The 5 categories are perfectly elastic supply, perfectly inelastic supply, relatively elastic supply, relatively inelastic supply, and lastly unitary elastic supply. Very frequently in examination, a question will be asked. Explain the meaning of the term elasticity of supply and what are the different types of elasticity of supply. So this explanation which I am giving will be very much beneficial to you. I have explained the meaning of the term elasticity, what is the formula for elasticity, and different types. Now one by one I will explain. The first one is perfectly elastic supply. Perfectly elastic supply means there is a huge change in supply due to a small change or no change in price. If there is no change in price but still there is a lot of change in supply, or if there is a marginal, insignificant change in price leading to a huge change in the supply, it is called perfectly elastic supply. In case of perfectly elastic supply, the value of elasticity of supply will be infinity, because a huge change in supply is occurring without any change in the price. That thing is called perfectly elastic supply. The situation in which there is a change in the supply of a product in spite of no change in the price level is known as perfectly elastic. In such a case, the elasticity value will be infinity. Next, perfectly inelastic supply. Here, whatever be the change in price, no change in the supply. No change in the supply. The supply will remain constant, fixed, whatever be the changes in the price level. That is called perfectly inelastic supply. Here the value of elasticity will be 0 because there is no elasticity, no change in the supply for any change in the price. So the situation in which there is no change in the supply of the product in spite of a drastic change in the price level is termed as perfectly inelastic. Here the value of elasticity of supply will be 0, no change. So two types I have explained: perfectly elastic, perfectly inelastic. Now relatively elastic supply. It is a situation where the percentage change in supply is greater than the percentage change in price. For example, the percentage change in supply is 15%, whereas the percentage change in price is only 10%. The price changed by 10%, supply changed by 15%. That is called relatively elastic supply. In this case, the value of elasticity will be greater than 1 because numerator is more than denominator. In numerator, we are taking the change in supply. Denominator, we are taking change in price. Supply is more than price, more than 1. Greater than 1. Next one is relatively inelastic supply. That means the percentage, the situation in which the percentage change in supply is less than the percentage change in price. Example, if the supply changed by 10% whereas price changed by 15%. So here numerator is less, denominator is more. The supply changed only by 10%, price changed by 15%, so 10 by 15. In this case, the value of elasticity will be less than 1. Next one is unitary elastic supply. Unitary means 1. That means the percentage change in supply is exactly equal to the percentage change in price. Example, the supply changed by 10%, price also changed by 10%. So 10 by 10, you will get 1. The value of elasticity will be 1 in case of unitary elastic supply. That's all. So I have explained you about the meaning of the term elasticity of supply formula. Then I have explained what are the different types of elasticity of supply. Now, determinants of elasticity of supply. Actually, elasticity of supply will not be same for every product. So different products will have different elasticities. Now, what are the determinants? How this elasticity will be affected? The main factor which affects the elasticity of supply is time factor. According to time factor, we can divide into 3 periods. That means market period or short period or long period. According to time basis, we are dividing the markets into market period, short period and long period. Now, market period, no factor of production can be changed, so elasticity is 0. That means market period means very short period. In the very short period, the factors of production cannot be changed. All overnight, the supplier cannot increase or decrease the supply all of a sudden. So market period is a period in which no supply can be changed irrespective of the change in price. That's why the price elasticity will be 0 in case of market period. Next comes short period. Short period is a period in which the producers or suppliers can change only the variable factor of production. 2 factors of production are there, variable factors and fixed factors. The fixed factors cannot be changed in the short period. In the short period, only variable factors of production can be changed like raw material, labor and so on. So these variable factors can be changed. So supply can be changed. So here in this case, there is a small elasticity of supply in case of short period. In case of long period, the producers or suppliers can change all the factors of production, whether variable factors or fixed factors. All the factors can be changed. So it's a period in which the suppliers will have full control on the supply. So that's why in the long period of time, the elasticity of supply will be more. Greater elasticity of supply in long period of market. Whereas small elasticity of supply in case of short period. Whereas no elasticity of supply in case of market period. So this is about determinant of elasticity of supply. Now the last topic in this video is regarding market equilibrium. So before studying the market equilibrium, we have to understand the market composed of demand from the buyers and supply from the sellers. So both have their own objective. The demand from the buyers wants product at a particular price in order to satisfy their wants. Whereas sellers, suppliers, producers, they will supply the goods in order to attain the objective of maximizing the supply and minimizing the cost. So here we have to understand demand and supply provide an analytical framework. So demand, on one hand there is a demand from the buyers, on the other hand there is a supply from the suppliers, right? So we need the analytical framework for the analysis of behavior of buyers and sellers in the market. So in order to understand this market equilibrium, first of all we must know that 2 parties are there in the market, demand from the buyers to satisfy the want and supply from the producers. We want the analytical, framework of the demand and supply to analyze the demand and supply of the market. Then demand shows how buyers respond to changes in price and other variables that determine quantities. So on the one hand, demand determines how buyers are responding to the changes in the price. Because normally, according to law of demand, when the price is less, demand will be more. When the price is more, demand will be less. Other things remaining constant according to law of demand. So here, demand shows how buyers are responding to the changes in the price. How much quantity they want to buy and willing to buy. That will show demand. Supply shows how sellers respond to changes in price. Price will occur in the market. So both are price takers. The buyers as well as have to see the price. So suppliers will see how much quantity they can be able to sell at a given price in the market. Now the interaction of buyers and sellers in the marketplace leads to market equilibrium. So buyers are looking at price, sellers are looking at price. So here in the market we have demand as well as supply for the price. The market equilibrium says the price at which the demand and supply both are equal. So a market is said to be at equilibrium position when the total demand in the market and total supply in the market are equal. Now, market equilibrium is a situation in which consumers can buy all the goods which they want and producers can sell all the goods which they want at the prevailing price. This wording, this paragraph is very important. So market equilibrium is a situation at which all the buyers will buy the products at a given price and all the suppliers will supply the goods at a given price. That given price at which all the suppliers are supplying, all the buyers are buying, so that total supply, total demand, both are equal at that price. The market will be at equilibrium. Now, in other words, equilibrium occurs when price is at a level for which quantity demanded equals the quantity supplied. Very simple. So, equilibrium is a situation. It's a price at which the total quantity demanded is equal to total quantity supplied. So, in equilibrium, the price is called equilibrium price and the quantity is called equilibrium quantity. When the market reached a position where the total demand and total supply both are equal, the price is called equilibrium price and the demand and the supply is called equilibrium supply. Now, to elaborate this market equilibrium, I have taken a simple example. First column I have shown the prices. Second column quantity supplied, then quantity demanded. Last one excess of supply or demand. Sometimes supply is more, sometimes demand is more at different price levels. For example, the prices are 65, 60, 50, 40, 30, 20, 10. You can see the prices are decreasing. When the price decreases, the supply will also decrease. According to law of supply says as the price increases, the supply will also increase. As the price decreases, the supply will also decrease. So here supply you can see 750, 700, 600, 500, 400, 300, 200. So what do you observe? When the price is decreasing, supply is also decreasing. But law of demand says when the price decreases, the demand increases. When the price decreases, demand increases. Here price is decreasing, so here demand, quantity demanded 0, 100, 300, 500, 700, 900, 1100. These three columns. Now last column excess. Excess of demand or excess of supply. So here supply is 750, demand is 0. So there is excess supply of 750. So plus 750. 750 minus 0 is 750. 750 is the excess of supply, whereas demand is 0. The market will have excess supply. At what price? 65. When the price comes down to 60, the supply is 700, whereas demand is 100. Again, there is excess of supply. 700 minus 100, 600 is the excess supply. When the price falls down to 50, then supply will be 600, demand will be 300. Now what will happen? There is an excess supply of 300. Next, when the price becomes 40, supply 500, whereas quantity demanded is also 500. What do you say here? At 40 rupees price, the supply 500 units and the demand is also 500 units. That means 500 minus 500, 0. there is no excess supply, no excess demand. The demand and supply both are equal, 0. Here 400 supply, 700 demand. So 400 minus 700 minus 300. That means demand is exceeding the supply. At 20 rupees, 300 supply, 900 demand, minus 600. At 10 rupees, 200 is the supply, 1100 is the demand. There is a deficiency of 900 units. So what do you observe from this one? When the price is high, the demand is low. There is excess supply. When the price is very low, the supply is very low, but the demand is high. We have excess demand. So we see at a point of time, both the demand and supply are equal. That means at the price of 40, you can see the supply is 500, demand is also 500, then 0 is the excess demand or excess supply. The table shows equilibrium in the market occurs when the price is 40 and both quantity supplied and quantity demanded are equal to 500 units. So excess demand and excess supply equal to 0 at equilibrium price. So it is clear from the table that equilibrium 40 rupees, at this point of time there is 0 excess supply, excess demand. No excess supply, no excess demand, both are equal. The price excess demand. Now this equilibrium price is the price that clears the market. Both excess demand and excess supply are 0 in equilibrium price. That the market will clear the excess position. No excess supply, no excess demand at the equilibrium price. This is about equilibrium market. So in this video, I have explained you about the elasticity of supply, meaning of elasticity of supply, formula to calculate elasticity of supply, what are the different types of elasticity of supply, and then what is market equilibrium. So if you watch the video twice, thrice, definitely, excellently, you can write in examination with full confidence. So thank you for watching this video, and inshallah we'll continue our topic of supply analysis in the next video.